Hi Tamal, thanks for coming on the show.
Thank you.
Now you were bang on the RBI policy, the three fronts that you mentioned. You were right there, the 50 basis point hike, the inflation not being changed, and the growth being pared down. It was as if you were right there with the policy. Now you are predicting a 35 basis point hike in the next December meeting. What about the 35 basis point forecast for the December meeting? What is your rationale for that?
Well, as you have noticed, Governor Das, unlike many other central bankers across the globe, has refrained from giving any forward guidance. He has said it would be data driven. Indeed, it would be. But if you read between the lines, in his interaction with the press, he disowned the word front loading. He said, I have not said that. Some MPC members have said that. And second part again, if you look at the governor's statement, it has gone back to June 2019. What was the level of inflation and what was the interest rate at that point of time? I'm reading out there when retail inflation was 3% and expected to rise 3 to 3.7%. The RBI policy rates were 5.75%. Now you have a retail inflation of 7%. So how can you have 5.9% rate? I mean, he has not mentioned about negative interest rate, but clearly hint is very clear. It's elementary issue. There's no escape from rate hike. So I would like to believe whether it's 35 basis point or 25 basis point, that's a matter of debate. We don't know. I think as we move, there will be a rate hike for sure in December, and probably 35, and yet another in February 15, so 25 basis point. So 5.9 to 6.25 and 6.5. That's a sort of terminal rate. I think 6.25, between 6.25 and 6.5, we would see the rate, policy rate, before the end of the fiscal year.
Even with that, we are in a negative real interest territory. Do you think RBI will try to alter that situation in this year?
No, I think it's not in India at all. If you look at the globe, I can't think of any country offhand where interest rate is positive. This is one of the unprecedented scenario where across the globe, across the countries, you have real interest rate negative. So India is no exception. I would like to believe we are probably marginally better off from some other countries, definitely better off from most of the emerging markets.
RBI governor somewhere said that 60%, 67% of our reserves had come down because of the depreciation there. What is the position on our forex?
Well, that, I think you need to do a arithmetic in this way. Our foreign exchange reserves has gone down by about 100 billion over the last 1 year, between last September and this September. Now, what are the components of foreign exchange reserves? One is foreign exchange per se. Second is second is gold. Third is SDR. And fourth is the money kept with IMF, which is far higher than rupee. That has contributed because to that extent your dollar reserve would depreciate. Second is gold. The price of gold has come down. So that has contributed to that. And the third factor is the M2M loss, which the bank treasury does. When the yield rises and the prices go down, you have to market your portfolio. So Reserve Bank of India's investment, so this, if 60 or 65% of its foreign exchange reserves, I mean the currency reserve, belongs to dollar, is dollar. I mean this dollar, the RBI does not keep it in its vault. It's invested, right? So when the price is going up, price is going down, and yield is going up, as you know the story in US. So certainly you need to book M2M losses, and to that extent your value gets eroded. So it's a combination of all these factors.
Yeah, I'll veer you towards another point that you mentioned in your column, but don't expand on it much. One, that's the liquidity front. The RBI governor seemed calmer than the markets and most analysts. Is there a need to worry on that front because credit growth has outpaced deposit growth?
On the liquidity, you have to see liquidity. You can see liquidity in different prism. One is this: you see the liquidity in or what is not available to banks, but it is there, like the government, the money of the government, etc. If government starts spending, it will come out in the system. And other is you just see the net liquidity. You are right, at this point of time, the net liquidity is much lower, and on some days, which is zero or minus, that's the case. But RBI governor is hopeful because the government's position is pretty good on the fiscal side. I think there's not much of worry in the sense the direct tax collections is good. So he expects that government will start spending, and that will add to the systemic liquidity. As far as banks' deposits are concerned, you are right, because as we speak, credit growth is 16% plus, which is a 9-year high, and incrementally, credit deposit ratio is, I think, about 112%, 112 odd, which means for every 100 rupee deposits accretion, new deposit accretion, banks are actually giving credit 112 rupees. Now, one is, where is it coming from? It's coming from their capital, right? Or because you don't borrow from market to build your loan assets. Borrowing from market is just to take care of temporary asset liability mismatches. So the banks have no choice. I repeat, banks have no choice but to raise their deposit rate.
Thank you. Thanks a lot for coming on the show. We hope to see you back again next week. Thank you.
Thank you.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.